Yo, what up, doe? It's Langston Hughes, and welcome back to Epic FX. Today, I'm going to give you all an introduction of price action. So price action consists of candles, support and resistance or range, and multiple time frames. With no further ado, let's get to it.
Fingers down my spine. Girl, you look mighty fine. Won't you rub your fingers down my spine? Girl, you look mighty fine. Won't you rub your fingers down my spine?
In this course, I'm going to show you how to use price action to effectively trade the Forex market with consistent profits. So what is price action? It's exactly what it sounds like. It's price. Price action analysis is the analysis of price movement. You'll analyze what price is doing now so you can predict its next movements. To analyze price action, we use two things, candlesticks and range, also known as support and resistance. Candlesticks are a highly detailed form of charting. Using candlesticks, we can build a high probable prediction of what price is going to do next. I'm going to dive deep into candlesticks with you. I want you to fully understand why they form, what they mean, and how to use them to your advantage. We'll actually be looking at each candle's story. That may sound silly, but each and every candle is telling you a story about what price has done and what price is doing. A candle story can show you when price is stalling, when price might reverse, when price will continue, and even when price is exhausted. This is very important as it will tell you when to trade, when not to trade, when to close your trade, or when to keep a trade open. When you look at a candlestick, you're looking at a representation of buyers and sellers. They tell who is controlling the market, buyers or sellers, and that's a candlestick story. For the duration of the life of a candle, it's the epic of the struggle between buyers and sellers, bulls and bears. Reading candles allows you to read the market's mind. When you can read candles, it makes your trading much more simpler, and when coupled with range, it practically provides you the icing on the cake. In conclusion, price action is simply using price and its key levels via support and resistance to identify the next movement of price. You may be asking yourself, if price action is solely focused on candles, then what's the opposite of price action? Let's take a look at that now. Many non-price action traders will use chart tools such as Fibonacci, trend lines, and various popular indicators. Some price action traders like to apply a few of them as well. Let's have a brief look at those items before moving forward. I'll also explain why they can cause more confusion than assistance. Fibonacci. This tool is often used to identify the depth of a pullback or retracement in a trending market. For example, Fibonacci traders will draw the tool from the beginning of the swing in a trend until the end of the swing, looking for price to pull back or retrace into a common level of 38, 50, 61, or even 78% before price continues the impulse. Sometimes the Fib tool is correct in what some would call a self-fulfilling prophecy. With many traders using such a tool, it could quite possibly influence the market. However, more times than not, it's incorrect. Not to mention that there's far too many levels to account for, ranging from 38 to 78%. Trend lines. Trend lines are normally used to identify the trend. I don't personally use them because I can eyeball the market and identify the trend. However, there's nothing wrong with using them to identify the trend, but do keep in mind that a trend line is just a tool and shouldn't be used as a form of support and resistance. Sometimes traders will use them in such a manner and quickly find disappointment when price breaks the trend line. A trend line is just a tool to identify the trend. Never hold expectations that price will respect your trend line. Now let's briefly look at some common indicators. Moving average. Many traders like to use the moving average, but not all agree on which one to use. The popular ones are 10, 20, 50, 100, and 200. The number represents the average of the previous candles. For example, for a 50 moving average, it will produce a line displaying the average movement of the last 50 candles. Some traders expect price to react to these lines once you find the correct number for your chart. I stay away from using such an indicator. I definitely don't suggest adopting this usage as a method of support and resistance. Bollinger Bands. This is a trader's favorite. It consists of 3 bands, one upper, one lower, and a middle line that's a 20 moving average. Some traders expect price reversal once price reaches a band on the outer limits. Other traders expect price to continue if it breaks to the outside of one of the bands. It appears that most traders are confused on how to actually use a Bollinger Band, with many various opinions. Additionally, Bollinger Bands are known to indicate the volume. When the bands are wider apart, then there's much more volume in the market, and when the bands are narrow and constricting, the volume is normally low or price is consolidating. I stay away from them. Ichimoku Cloud. The Ichimoku Cloud is another popular indicator. Many say when price is above the cloud, then look for buys, and when price is below the cloud, look for sells. There's a couple lines here as well. Some traders will suggest waiting for lines to cross and then wait for price to move above or below the cloud before entering a trade. It just all seems so confusing and places unnecessary complications on reading the price. RSI. The RSI is something I actually do like, but it's not necessary. It's an oscillator similar to MACD. RSI stands for Relative Strength Index. Traders believe that once the RSI reaches the top, it's considered overbought, and once it reaches the bottom, it's considered oversold. This could mean a potential reversal is waiting to happen. However, the market is never overbought nor oversold. If this was the case, price could never make new all-time highs. If we really dissect the method of RSI, you will see that it's actually showing overbought when price is approaching a previous swing point. I don't find the need to use RSI. These are some of the most popular tools and indicators, but there's actually much more. Thousands upon thousands of different indicators to add more confusion to traders and distract them from price. Let's have a quick look if we apply all of these, which some traders do. A hot mess, right? Let's keep it simple and profitable. Let's focus solely on price action.
There you have it. That's price action. Let's keep it simple. Let's keep it profitable. Let's keep the charts clean and nice. And remember, price action, you can use it for Forex, crypto, any sort of trading instruments that requires technical analysis. So don't forget to like, subscribe, and comment. And do let me know if there's anything specifically you want me to create in the future. Until next time, peace.